Welcome to my weekend market recap 27th November 2021. I'm Sagar Nandi, retired IT professional, swing trading stocks using Q systems and techniques. This is my email ID, my website, YouTube channel, and Twitter handle. I regularly share live market and stock analysis on these channels. You are most welcome to make use of them. Disclaimer: this demonstration is for educational purposes only. I am not an investment advisor. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. And I may mention about options trading from time to time. You may refer to the characteristics and risks of standardized options document from Options Clearing Corporation to decide if option trading is suitable for you. I use the Q systems in my trading. They run as add-ons on Metastock and TradeStation platforms. Let's continue with a look at the global markets, starting with Australian index, all ordinaries. And here you will find something interesting. When price was at this point, coming down from upper edge of a sideways range after displaying multiple bearish indecision and bear release, then a bearish flow. Right at that time, I suggested taking a bearish trade using the idea that low risk entries can be made at the upper edge of a sideways range, and I suggested instead of using the all ordinaries as an index, we could use short call vertical. Then I followed the trade in subsequent webinars and I showed that the trade was in a profit and it did not go outside the upper edge. Therefore, even if you traded with all ordinaries itself, you would not be stopped out. But the preferred instrument for me in these cases are short call vertical. It continued to remain in profit and on Friday price dropped sharply, hit the next trendline support that would be our profit target. So we would exit the trade on Friday. Because we had used short call vertical, we would not get stopped out even if price went above the upper edge, which it didn't, and we would exit the trade with discipline when price hit the initial profit target without waiting. We would gain because of the delta move down and as well as time decay for several weeks. That's why I prefer to take short verticals in reversal trades and use the instrument itself, maybe stock or future or ETF for trend following trades. That is a general guideline for Q techniques. Australian market is continuing to be inside a range bound by trendline resistance, trendline support. It is at the lower edge of the sideways range. So it is too late to take a short trade. We took short already here. You could take here, you could take here at the upper edge, not short at the lower edge. Instead, if price goes up from here, we may look for a low risk buy opportunity. When can we take short again? If price can break below the trend line support, then recovers little bit and goes down again, that will give the next low risk shorting opportunity. Probably that will be using go with flow trend following short trade setup. What about Japanese market? Topix index. Earlier it was going up with higher high, higher low. At the top it displayed the bearish indecision signal, and I mentioned in the master classes that one bearish indecision is significant, cluster of them together is more significant. So two of them displayed at the top, then price came down. At this point it broke below the trend line support, so the uptrend was broken by this bearish flow magenta color candle. After that price drop on Friday, hit the trend line support. Weekly is also a trend line support. We see this commonality between Australian market and Japanese market. Both came down, especially near the end of the week, and both are at trend line support, at a point where I will not like to short. In fact, if I had earlier short positions, I would have booked profit at the close of Friday. That would be true both for Australian market and also for Japanese market. What about China market? China market doesn't seem to be impacted by anything, continuing to move sideways, bound by watermark resistance, trendline resistance at the top, bound by watermark support, trendline support at the bottom. Not going anywhere. We will not take any directional trade in China market. Next is Footsie index, UK market. It was inside a box. It went to the upper edge of the box and you could short right at that point. Using the same technique that I explained a while ago and in earlier webinars for Australian market, using the same technique you could short at this point, and preferred instrument would be short call vertical. On Friday price dropped sharply. The short call vertical would be significantly in profit and you could book profit, at least partial profit. Would you book full profit? I might not, because here it is inside a range and it is still some distance away from the lower edge of the range. Friday's candle shape is very bearish, so in case of Footsie, I would book partial profit in any short call vertical taken at the upper edge. Partial profit I would book on Friday and I would continue to hold partial position, expecting it to come down to that trend line support. But if it goes up from here, I will use trailing stop to book profit in the remaining position. If it continues to go down, I like to book profit at the lower edge of the sideways range. This is also inside the range, but it is not at the trend line support yet, which was true for both Australia market as well as Japanese market. Footsie continues to be inside the range. And lastly, India's Nifty 50. Once again, the bearish headwinds came handy, and in trading jargon, handy means effective or profitable. I pointed to the bearish headwind right at this point. That time price was at all-time high. Not many people would think about shorting, but Q systems have this unique signal, headwind possible reversal signal. The headwind comes before the reversal actually happens. Very unique in that way. And in fact, using the headwind signal, some of my India trading friends know, I started shorting, and during this 1, 2, 3, 4, 5 weeks, you see the backdrop has remained bearish all along. Backdrop could never turn even yellow. Forget about cyan. On Friday, it dropped sharply. It was dropping already. Friday, it dropped even more, and it has broken below the trend line support. In fact, from the top to the Friday's close, most of my trades in the Indian market was short direction using either futures or options, and most of them I closed with profit. So though many of the other India traders took a big hit who continued to keep buying, I could close most of my trades with a profit, and that is because I could anticipate a reversal change looking at the bearish headwind. Now it is in clear downtrend. It has lower high, lower low, and the trend line support is also broken. Is it a bit too late to short? That may be true. Whether it is really oversold or not, you could make that out more accurately by using Q edge, looking at the bucket analysis. I'll not do that for the India market, but you may check that out yourself if you are trading in the Indian market. I'll cover the bucket analysis for the USA market. If you shorted earlier, you could continue to hold at least partial short position in the India market because Friday's candle is bearish in color and shape. The uptrend is now broken. It may be a bit too late to short, but the uptrend is now broken. That was a look at the global markets. China market moving sideways, UK market moving sideways. Australia, Japan came down, but they are right at trend line support. India market broke the trend line support, therefore it is not in an uptrend anymore. It closed near trend line support. It may be a bit too late to short. That's a mixed picture showing weakness but also showing support at Friday's close for multiple markets. Let's see what happened with the USA market. SPY, and here is another profitable trading analysis that I made in the previous webinar. In the previous webinar, when we were around this point, I explicitly mentioned in the last market recap that I would not be a buyer. Instead, I would like to short SPY. And why did I say that? I said that because it had a bearish headwind. It was near watermark resistance, and therefore any down move would give me a false upside breakout, a very low risk shorting opportunity. And at that time, the weekly had a bearish indecision at the top. The shorting opportunity came right on this red color candle, bearish traffic light candle, that created the false upside breakout, and it also created a reversal candle at pendulum high. That was my shorting entry point, and if you took that short by Friday's close, you would have significant profit. You could close at least partial position. What would be the suggested instrument when you or I shorted at the top using false upside breakout. That was a reversal trend. So the preferred instrument would be short call vertical, which would benefit from the delta move as well as from time decay. You could easily book profit on Friday. Once again, a technique and trade that I discussed before knowing the result when many people were actually bullish, but I discussed a short trade and that could be closed with profit on Friday. And if you see the pattern, once again, when many people are bullish using the Q signals and multi-angle analysis, I am able to take contrarian trades with very low risk. One thing that is common in all my trades is that the risk is very low. So I would not like to short on Friday. I would have shorted earlier. On Friday, I would book profit. In the daily, the uptrend is broken now. It has a lower low, created a false upside breakout. Uptrend is broken. It is too late to short. What is the possible next trend? I'll be happier if it recovers little bit and comes down again. That will give the easiest low risk entry point for the next short trade, which will be a go with flow short trade. Is it possible that it will recover? Yes, it is possible because the market is oversold. We'll look at that. But before that, let's look at the other market ETFs. QQQ. QQQ also created a false upside breakout. Once again, if you watch the bearish headwinds coming at this level where we had a watermark resistance, you would be cautious and avoid buying. What did I mention in the previous market recap? I said I was not going to buy and I was not going to short because previous market recap was at this point. It was the strongest of the market ETFs and I was not going to short the strongest of the market ETFs. I was not going to buy also. I explicitly mentioned that. Then it created a false upside breakout at the level where bearish headwinds came earlier. Price came down. Weekly also had a reversal candle at pendulum high. Here the uptrend is not broken though. We don't have a lower low yet. We still have higher high. So QQQ is continuing to be in an uptrend. Another thing to notice, let's go back to SPY. Yes, there was a huge drop in price on Friday, probably due to the news related to the new variant of coronavirus. But that is what the media is telling. I don't look at the media to make trading decisions. I know the news, but I don't make my trading decisions based on news. One thing to note that Friday was half day, and yes, price dropped for SPY with very high volume shown by this dot appearing on the volume or activity bar. But if you look at the weekly volume, it is below average. So it did drop. SPY in fact also made a bearish reversal at pendulum high. That is a reversal signal. But volume was low for the week. That would be expected probably because it was a holiday shortened week. But I also notice one thing now. I forgot to mention that earlier. It has 3-month big move down at pendulum high. That is never a good sign. When we have 3-month big month big when we have 3-month big move down at pendulum high, usually that leads to further correction. May not happen right on Monday, but usually that leads to further correction. That will be a reason not to buy now, not in SPY. And of course, the flow and backdrop both are bearish. Why I came back to SPY is to show that the weekly volume is not high. And if I go back to QQQ, here the weekly volume is above average, thick bar, but nowhere near the very high or extreme high levels. Nowhere near those levels. And we don't have a big move down of 3 months in QQQ. QQQ is not in a downtrend. Uptrend is still intact. If we look at DIA, once again, paying heed to the bearish headwind could save the beacon. We wouldn't buy at the top. Instead, we would protect our position with trailing stop. That would be very handy. On Friday, price dropped sharply. However, it closed with indecision at the bottom, that is bullish indecision. Not very far from trendline support, though it has still some distance to go. High volume on Friday, especially when you know that Friday was only half day, Friday's volume was very high. Weekly volume is still not very high, expected holiday shortened week. And once again, I see the cautionary signal 3 month down at pendulum high, and from the color change I know it is at pendulum high and reversing. So that's a cautionary signal. I would expect more correction to come in the coming days and weeks. It may be a bit oversold right now to short, but I will be happy to short if it goes up little bit and comes down again, giving a low risk with flow shorting opportunity. Here the uptrend is clearly broken, but for longer term analysis it is near a trend line support, near, not at trend line support, but near the trend line support. That will be a reason not to short it right now, but uptrend is broken for swing trading purpose. And IWM, remember when discussing market breadth total view, I think 2 weeks ago, not even 1 week, 2 weeks ago, I showed, and at that time, small cap was the strongest. I showed that it was starting to topple over. That was very timely, meaning profitable analysis, because since then, small cap is the worst performer. This relative performance sharply tilting down is also showing that. However, on Friday, it closed above the weekly and daily trendline support with very high volume with bullish indecision at the bottom. Once again, see how I am using the Q signals to anticipate a move down from the top, that I explained using the market breadth total view. And now at the bottom, I would book profit if I had a short position, maybe using this go with flow short signal, but I would not short on Friday because it held the trendline support in daily and weekly both. If anything, if price can go up from here, a close above Friday's close will confirm a bounce long trade setup. I may look for that, and bounce long trade setup or bounce setup in general, long or short, they are extreme reversal setups. What is the preferred instrument? Shorting options. Therefore, short put vertical would be the preferred choice. Such a choice will benefit not only from delta move but also from time decay. Okay, not only delta move, not only time decay, but also from volatility collapse, because when price fell down heavily on Friday, volatility will be very high, so short put vertical would have all the three advantages. Advantages from time decay, advantages from price moving up, delta move, and also from volatility collapse. So certainly at the bottom, bounce long setups, preferred instrument is shorting options, short put vertical to lower the risk, not naked short. I would use naked short on individual stocks that I am willing to hold longer term. I may not want to use naked short on market ETF. I would do that on fundamentally strong stocks. IWM weakest but right at the support. So we see market drop. Well, one thing to note that here also we have 3 month down and price came down from pendulum high. This 3 month down at or near pendulum high, that is seen in 3 of the 4 market ETFs. That is always a cautionary signal. Almost always, I will not say always, but almost always that leads to a bigger correction down the line. And we could anticipate such a move from several angles. One angle would be the sector industry stock advanced decline breadth. Sector industry stock advanced decline breadth 1 month to 1 day. If you remember my market recap 2 weeks ago, then it was mostly green. If I remember correctly, 2 weeks ago, 5 day period was red, but 1 and 2 day periods were green, and 10 day 1 month period was also green. That was 2 weeks ago. What was there 1 week ago? 1 week ago, 10 day was somewhat green, 1 month was very green, predominantly green, and 5 day, 2 day, 1 day were more red than green. So from 2 weeks ago to 1 week ago, it weakened. So we could see the sector industry stock advanced decline breadth weakening from the previous market recap itself. The videos are of course on my YouTube channel. You may review them and see how looking at the market from these different angles helps me and you and everybody to anticipate a move. So using that anticipation also, we would not look to buy many stocks. The bearish headwind coming in multiple market ETFs would be another reason, and that anticipation of weakening market came true here also. Now every period, in fact, 1 day to 1 month, everything is bearish, and especially bearish from 10 day to 1 day. 1 month is still bearish but not as bearish as the other periods. Now when you look at the 1 day to 10 day period, it is not only bearish, it is looking extremely bearish. That is a sign of oversold condition. We saw the market ETFs already dropped significantly. They are far from recent swing high. That would be one reason I would not like to short on Friday. IWM being right at trendline support, I would not like to short on Friday. Another reason I would not like to short on Friday is this sector industry stock advanced decline breadth is also looking oversold. Certainly not bullish, I'll not buy, but I'll not short also on Friday. And let's look at the bucket analysis. The percentage of stocks in S&P 1500 above mid Bollinger Band is only 17%, below mid Bollinger Band more than 80%, 83%. That is also oversold condition. And if we look at the distribution of the stocks across their Bollinger Bands, dividing the Bollinger Band into 10 equidistant buckets 1 to 10, and putting everything above upper Bollinger Band in the greater than 10 bucket, putting everything below lower Bollinger Band in the less than 1 bucket, calculating the percentage of stocks in each bracket, and plotting it as a histogram gives this bucket analysis. Today versus yesterday, so Friday versus Wednesday if Thursday was market holiday. We get this picture and we see it is predominantly bearish. The area under the red bars is much bigger than the area under the green bars. In fact, yesterday during market hours, the percentage of stocks in the lowermost bucket, it hit almost 40%. Let's look at the post. I tweeted about it right at that time. Here it was at 10:20 a.m. Eastern Standard Time. I showed that sector industry stock advanced decline breadth was very bearish. I could do that in real time. And I also showed the percentage of stocks in the lowermost bucket hit almost 40%, 38%. That is very high percentage. Usually when it hits 30 to 40% level, it recovers. At the lower side, it recovers. At the upper edge, it would start to pull back. Now, if you look back, I tweeted about the uppermost bucket hitting 30% or so right on the day it happened. And if you look back, go through the tweets, you will see when I tweeted that the uppermost bucket hitting 30% or more, that was the top. After that, the percentage of stocks in the uppermost bucket kept on coming down, closing at only 0.9% on Friday. So looking at the bucket analysis in real time was not only helpful, not only very helpful, extremely helpful to anticipate a pullback. That was a profitable analysis once again. And now the percentage of stocks in the lowermost bucket is hitting almost 40%. That would be one more reason why I would not like to short on Friday. I would not buy, but I wouldn't short also on Friday because it is severely oversold. Now, could we anticipate the market downturn from some other angle? Yes, we could do that, and we could do that handsomely from market breadth total view. The Hindenburg signals were not coming for a while, and I realized that the Hindenburg calculation is very rigid. We have to do exactly the way it was designed to be used, and I'm using fire for aggregation. I'm also figuring out how fire works. So the way it was aggregating data was not probably what the inventor of Hindenburg had in mind. So I seems to have fixed it. Now you can see the Hindenburg signals. I'll release it shortly. This is the Hindenburg appearing on the USA market breadth total view. What is the candle chart? It is actually a total view custom index calculated based on the two composites and four major indices. This candle chart is not of any market ETF or market future or composite. It is total view custom index created from the two composites four major indices. And all other calculations are also based on these two composites four major indices. This total view is extremely helpful in showing in one page a lot of insights about what happened in the past and what is probably going to happen. So we could look at the Hindenburg signals, a cluster of them, and anticipate a down move. And if you look back this screen length, we had a yellow Hindenburg here. We had a yellow Hindenburg here. Why yellow? Because they are not in cluster, isolated ones. And Hindenburg signal in isolation is not that important. When we have a cluster, the Q market rate starts to show them in magenta. And skull is quite scary, isn't it? I think that was a good design choice. Well, it was my choice. I like that. So when these clusters started coming, we would also be careful about buying and we would look to short and protect long positions with trailing stop. That would be also very effective, that is profitable. That would be another reason we could anticipate a market drop. Another thing that I explained earlier in market recap, we could anticipate a market drop from there also. That was percentage of stocks above 50-day moving average. From this point onward, it starts to come down. If you look at the market ETFs, they were still going up, especially SPY, QQQ, they are going up, but the percentage of stocks above 50-day moving average was coming down, creating a bearish divergence, and it was creating lower high, lower low. And I mentioned that in those market recaps, not after the fact. I see many people pointing to things after the fact. I try to avoid that. I pointed to this downtrend of yellow line earlier. And in fact, the white line and the orange line, percentage of stocks above 200 MA, percentage of stocks at 50 MA above 200 MA, they were also tilting down. But the yellow line, percentage of stocks above 50 MA is most sensitive. So usually I focus on that in the webinars while I look at the other lines as well. So that would be another reason that would caution us that a market down move was coming. And it in fact came. It came so much so that we finally have a large distribution count of 5. If you look back, and I'm looking back right now, for the entire screen length, we don't have a distribution count of 5. So we had a very bearish day from this angle. What does this distribution count mean? It means heavy selling and heavy selling across the board. Across the board where? In 5 of the 6 components. Where from did they come? They came from Nasdaq Composite, NYC Composite, S&P 1500, S&P 500 and Dow Jones. Only Nasdaq 100 did not have a distribution count on Friday. And just now, a while ago, I also looked at the market ETFs and we saw that QQQ is still not in a downtrend. Uptrend is still intact, and that strength is confirmed from the distribution count also. Nasdaq 100 does not have a distribution count on Friday. All the other composites and major indices has. That is very bearish because for the entire screen length we didn't have a distribution count of 5. It has already fallen down somewhat from the recent swing high, so it may be too late to short unless you are using intraday fine-tune chart next week. And if market starts to come down, you may use intraday charts to short, but using daily weekly it may be a bit too late to short. Is it overdone? Is the down move already complete? If we look at the 3-month new high low, it is near the lower extreme, but it's not quite there yet. It has little bit more way to go. Once the 3-month new high low hit the lower extreme, it tends to go up. What tends to go up? 3-month new high low. Doesn't mean the market reverses all the time, but 3-month new high low goes up. What does it mean? It means the stocks making new highs starts to go up, or stocks making new lows starts to go down. In either case, you may take bullish trades. In stocks that are making new highs, you could look for trend following or breakout bullish trades. In stocks where number of new lows is coming down, you could look for reversal trades like headwind, box, or bounce. It has little bit more distance to go before we can start to expect a recovery. Now, if the market dropped on Friday because of the COVID concern, it may be useful to see up to what percentage level this yellow line dropped in the previous COVID scare, that was March of 2020. Now the yellow line for the market breadth total view is around 40%. Can it go down to 20%? Usually when it goes down to the 20% level, I start to look for buying. It is still 20% away from the 20% level, percentage of stocks above 50 MA. And it can go down further. How far did it go during the previous COVID scare of March 2020? And I checked that out. It went to a very low value of 2% or so. That means only 2% of S&P, sorry, not S&P 1500, only 2% of this market breadth total view stocks were above 50-day MA at the bottom of previous COVID scare. And let's look at that. This was the point. Incidentally, okay, let me zoom a little bit and scroll back. Incidentally, in March of 2020, when the first COVID scare came, market dropped significantly. We had a large distribution count of 6 on the first day of the drop. That is equivalent to Friday's drop, this Friday's drop, when we had a large distribution count of 5. Last time we had large distribution count of 6. Currently we have Hindenburg in magenta color. In the previous time also we had cluster of Hindenburgs in magenta color. So that was telling us that a down move is likely. Then the large distribution count pointed to the first down move. And notice that after the first large distribution count, it continued to go down a lot more. So if that is any parallel, then this Friday's down move does not mean that the down move is done. And if you look at the yellow line now, the percentage of stocks above 50 MA, last time at the low, if you read right at the low, let me use the cursor, and you may read the number from this bottom right corner. You can see it is at 2.06%. So at the low of the COVID crisis in 2020, only 2% of stocks were above 50-day MA. What is that percentage now? We saw it is 40%. So if last COVID crisis is any indication, we have still a long distance to go. That is a reason not to buy now. When to start buying? We may wait for a follow-through day. What will be a follow-through day? A follow-through day will be either a Eureka day or a large accumulation count. And let's look back again. During the last COVID crisis, after the Hindenburg, after the large distribution count, price fell significantly. And you see the 3-month new high low hit the lower extreme and stayed there for a while. Then it tried to go up with large large accumulation count 6.4. We would not buy in the first up move. Then price pulled down. Then it went up again, and we had Eureka day. shown by cyan bars, and we had large accumulation count. So which would be our first follow through day here? This day. We would start to buy from that day. We may look for a similar follow through day indicated by Eureka and or large accumulation count. Probably they will come together again to look for our next buying opportunities. We are not there yet. Also, I mentioned that several market ETFs are showing 3-month big down move at pendulum high. Usually that leads to further correction. Those were different angles to look at the market. Let's look at the USA composites to see whether Nasdaq is stronger or NYSE is stronger. The yellow line, percentage of stocks above 50 MA. For Nasdaq, it is at slightly above 30% level. For NYSE, it is at 40% level. So NYSE is once again continuing to be stronger than Nasdaq by about 10%. And the yellow lines for both of them are in a downtrend with lower high, lower low below the 50% level for both and below the average line also for both. So the yellow line is showing weakness. And in these two composite charts, you can see the Hindenburg signal again. And you know the Hindenburgs in total view, are they coming from NYSE or NASDAQ? And you can see that in fact they came in both NYSE and NASDAQ, maybe on different days, sometimes on same day, but they did appear in NASDAQ as well as NYSE in magenta color. Now let's change to the weekly interval, and this also I mentioned in the previous webinars that the advanced decline was showing bearish divergence, so was up down volume. That was another factor I pointed to in previous market recaps and suggested not to buy too many stocks. So we had a lot of signals telling that a down move may be coming, and that indeed came true. What were those signals? Bearish divergence in advanced decline up down volume, downtrend and bearish divergence in percentage of stocks above 50 MA, Hindenburg signals and bearish headwind signals on market ETFs, and also the reducing sector industry stock advanced decline breadth. Bucket analysis showing market may be oversold. Sector industry stock advanced decline is also showing that, and let's look at the technical breadth. Is it oversold? Yes. Balance between bearish and bullish signals using weekly interval fast using Q finder. 91% of all signals bearish, 94% of strength signals, 94% of trend continuation, 86% of reversal signals. Everything is very bearish, too bearish that it is oversold. At the same time, if you see the percentage of stocks showing bearish headwind in the weekly interval, it is now more than 1%, 1.6. So that will also be a reason not to try to buy now. When the percentage of stocks showing bearish headwind in the weekly interval goes to 1 or 2% or more, that shows further weakness may come. So though we have very oversold condition, further weakness is likely. We are seeing that from many angles. I'll not like to buy now. That is a general statement. Individual stocks in some industries may go up, but broadly speaking, I'll not like to buy. And if we look at Friday's signals, that is as bearish probably as it can be, in spite of being a half-day trading session. See the bar graphs. The green bars are almost non-existent. and the percentages are also showing severe bearish condition, maybe a bit too bearish, again looking oversold, but there are indications that it may continue to go down further. Technical breadth also telling the same thing. Those are many different angles to look at the market, all from different perspectives, different calculations. They tell us all the same thing, that market has dropped, it is very bearish, it has some support, maybe oversold in some ways, but further weakness may come. I'll not like to buy now. Having said that, I did run some scan looking for long trades, and let me show that. I'm not going to buy, I am bearish on the market, but if some positive news comes on the vaccine front, that the vaccines, existing vaccines can work against the new coronavirus variant, maybe market will rally. What kind of stock will do better? Probably stocks that did well on Friday, even on Friday. So I ran this scan looking for long all setup on Friday, any of the Q trade setups. You could look for those using Q Elite, you could look for those from Q Finder also. So I ran this scan. Let's look at the report. We have a number of stocks here that gave one or other of the Q signals, only those stocks, and I ran it on a list of all liquid, mid and high price stocks. One stock that caught my attention is Snowflake. Snow. It has a pullback long setup. Let's look at Snow using Q charts. Snow is in a confirmed uptrend. Well, let's look at it using daily first, then I will switch to the 3 chart template. It's in a confirmed uptrend, and interestingly, once again, when did the uptrend start? Right after displaying the bullish headwind at the very bottom. That's why I always, and all Q traders always pay attention to headwind signals. In this case, the headwind once again caught the very bottom. It is in a confirmed uptrend now. The yellow direction line has consistently held. Price could not go below that. Now at the recent top, it displayed cluster of bearish indecision. Price sharply dropped, stopped right at the trend line support as well as yellow direction line, created a bullish indecision at the bottom, then went up for 2 days in a row, giving a pullback long trade setup as of Friday's close. And one day earlier, you also had a bounce long trade setup. Now let's look at this chart using 3 chart template. Now we have even more reason to buy. The weekly also has a trend line support. Daily has trend line support, we already saw that. In the alternate signal, there is not additional signal to read, but from the daily I can see that it had bullish pressure and bullish U-turn and a bull release signal right when it reversed from trend line support with bullish indecision. So you could buy on this day using a bounce setup, or you could buy on Friday using pullback setup. Both would be valid long trades if you were willing to buy when market was falling sharply. So this stock is certainly showing strength. When the market dropped so sharply and this stock paused right at trendline support, started to go up for 2 days in a row, those are the kind of stocks you may look to buy if your market view turns bullish. And once again, when it stopped right at the trend line support, went up the next day, what would be our preferred instrument? It would be short put vertical. And if you are bullish on the stock, this is not ETF, you are bullish on the stock, you are willing to hold it longer term, you could also use short put. Only if you are willing to hold the stock long term. Now, how is Snowflake's fundamentals? We can see from the chart here that it is a new IPO. So the fundamentals may not be everything. You may have to study the stock. I use Zenith for that or Icon for that. You may study the stock to see if you like what they're doing. Are they coming up with new product, new business? But having said that, let's look at the fundamentals. Maybe we'll not find much from there. Retrieving data from Refinitiv. I don't store any data on my computer. Snow.k, new IPO. So there is not enough data, probably valuation is not good, no earnings. That I mentioned already. For new IPOs, fundamentals may not be useful all the time. You may have to look at what the company is doing. You may read about that from here and do further analysis from Zenith or Icon. Now, if you read the business description here, you would know it is in cloud computing. It does have one short squeeze potential. Interesting is if we look at the industry using Q edge, Friday was a down day and I can say 81% of the stocks were down. So I expect this industry is to be also weak. And indeed, its score came down. The industry as a whole was also down. That is expected. The market was very weak on Friday. But if you look at the relative score, this is something interesting. Yes, the market was certainly weak on Friday, so we would not expect many stocks or even industries to be up. But look at the relative score of the industry. It is among the top 20%, and it was much weaker earlier, gradually improving among the top 20% relative score industries. That is an industry where you may like to focus on to find the next buying opportunity. This is relatively strong industry, and this stock is certainly looking strong. That is how you may look for stocks to buy in case your market view turns bullish. I'll not take more time today. We are at the 1 hour point. I demonstrated how using different angles you may have a very complete, accurate and often profitable picture of the market. You can anticipate market moves and also how to find strong stocks even in such a weak market. That's all for today. Thanks a lot for attending. I look forward to seeing you in my next public session, which will be next weekend market recap. And for the people who are attending the master classes, the next master class on Q scans will be on Tuesday, 11 a.m. EST. Thanks a lot once again. Have a great weekend. And as these examples show, no reason not to do that. Trade profitably. Thank you.